Hi, everyone. Welcome to the Canadian Passive Investing Show. I'm your host, 𝗖𝗽𝗶 𝗖𝗽, and I'm joined by my co-host, 𝗖𝗪𝗓 Biniaz. We, of course, have another incredible show for you today. Please like and subscribe as it helps us build our channel and allows us to keep bringing you great content and expert guest speakers. Our mission is to empower investors to earn passive income through real estate investing. Today, we are joined by Reid Bennett. Now, Reid serves as National Council Chair of Multifamily Properties for SVN International. He has been in the multifamily apartment brokerage space for 20 years and works with both market rate and affordable housing owners and operators around the country. Reid has also invested with many of his clients, as he does not compete with his clients and those he serves within the market. So we believe this interview with Reid will bring great value to multifamily investors across the US and Canada, as Reid's perspective and wisdom about the market and the multifamily sector could help them greatly. We also believe this interview will bring great value to passive investors looking to learn about the nuances about the relationship between active investors and brokers. So thank you for being with us today, Reid. Welcome.
Welcome, Reid.
Hey, thank you guys for having me. I really appreciate it. Good to see you.
Yeah, good to see you too.
Yep.
Reid, let's just dive right into things. Maybe if you could tell us about your background and your start in multifamily.
Sure. Well, 21 years ago, I was running a personal training studio in the basement of a downtown Chicago building. Most of my clients were either attorneys or real estate brokers and investors. And so I would just spend the hour-long session just grilling them about, what do you do? How do you do this? And I'll never forget the guy that came down. He would show me a check that he just closed a real estate transaction, and it was more than 2 years of my salary in my position. And I said, and this guy's an idiot. So anybody can do it. So it's kind of what got me into it. And one of my clients said, look, you go get your license, kid, come on up, here's your office. And the office was overlooking the river in downtown Chicago. And I just thought that was the coolest thing ever. I went and got my license in a week, started with these guys, and the rest is history.
The rest is history. Amazing. That's very cool.
Maybe you can also talk to us about being a broker. Obviously, you can be a residential broker or what have you, but you can also be a commercial broker. So, what was that early on that you wanted to be in the commercial space, or was there a transition you made into that?
Yeah, I never got into the residential. What got me really interested in real estate was the investment angle of it. I had my roommate from college, the last year that everybody was there, he bought a house and rented it to all of us. And then he ended up amassing about 60 homes on the campus of the University of Iowa, ended up selling them, buying an apartment complex, doubling his money there. And I said, wait a minute, this is fantastic. He gave me the book Rich Dad Poor Dad in 1999. So I read that and I said, oh, this is totally different than what I was taught growing up. And that's really what got me involved.
Yeah, being in the real estate space for the past 15 years, I definitely see a difference between residential brokers and commercial brokers about their view and perspective of the market. Residential brokers is more personality. Commercial brokers is more data and numbers.
Is that what you say?
That was
yeah. I mean, I never
towards any residential. I used to be a residential broker 16 years ago. Yourself for a long time, but
sure.
I love
no
it.
jab there at all.
No. I mean, I don't care about what the kitchen window looks out upon from a piece of real estate. It's just about what the numbers and what they look like and what you can do to adjust them upward to make the value greater on the property. It's not residential by any means.
Yeah, totally different. Now, Reid, we started CPI Capital amid COVID pandemic, and we saw firsthand the anxiety investors felt when COVID first started. Sure. But then all the fears evaporated when the government started printing $2 trillion and literally started handing it out to people. And I believe another $1.5 trillion is being printed, added to that amount shortly. But we saw the market go on a bull run never seen before, which it is still in now. Maybe you can walk us through how you felt, Reid, when COVID got serious and then eventual reversal that took place within the market exploding.
Yeah, it's unbelievable. I mean, first of all, I didn't even know what $1 trillion looked like. It's a 1,000 billion, right?
Yes.
Is it?
And a billion's 1,000 million. So I mean, I can't even fathom with the money that's being thrown out there. But I'll never forget. So it was. I do a multifamily call internally at SVNI. I run the call for all the multifamily focused advisors across the country, and it was always the last Thursday of the month. So I'll never forget. April 2020, going into May 2020, I had guest speakers on that were lenders. And the lenders, I remember saying, make sure you tell your owners and operators to brace themselves for 25 to 50% at best collections the first part of May. And having gone through 2008, 9, and 10 in this business, I remember getting off of that call and at dinner to my wife, I said, should we stop paying our mortgage so we can just start, piling up money, in case we go through a 3 or 4? I mean, I thought it was going to be a 5-year downturn from, some of the stuff I was hearing initially. And it never happened. We went through May, nothing happened. We went through June, nothing happened. July, the entire summer. Then we went, we're in November of, 2020 and nothing was happening. In fact, like you said earlier, cap rates were starting to compress for some reason. Price values went sky high, even though there were eviction moratoriums across, especially across the United States. But what I found was a lot of the office and retail buyers stopped buying. They froze their acquisitions on that end, and they jumped into the multifamily space. And so you had a number of groups that never looked at multifamily starting to drive the prices through the roof within multifamily. And we do affordable as well. So one of the hottest lending tickets was project-based Section 8, because since the government's printing money, the government is going to pay their rent. So the cap rates compressed on the affordable housing immediately, and then multifamily, it's been unreal. I have one client that I was talking to, 3 months ago, and he's pretty aggressive. And he said, look, we have over $370 million under contract, we're bidding on $370 million with the multifamily. And, his ego said, I think we're going to get all of it. And so then I had followed up with him a couple months later and said, so, how are things going? He said, we didn't even get invited back to the table on any of the deals. And this is, we're talking about a group that was outbidding other people by $1 million or $2 million on deals. So it's just amazing. It feels a little bit like, the 06, 07 condo craze days. I don't know if that happened up in Canada, but here in the United States, it was, the condo craze was 05, 06, 07. And everybody was saying, how can these groups afford to pay this price? And then we found out in 08, they couldn't, because they lost it all. So it feels a little bit like that, but I don't see all the metrics that everybody ended up seeing in 2006 and 7 and 8. So this is a little bit different.
Yeah. And just to add to a couple of your points there with different sectors kind of getting involved in multifamily, the office space, retail, and with hospitality. You got to understand that a lot of these big firms now, with us being smaller firms, we know how important it is bringing on a virtual assistant or a contractor, and how hard it is to find the right person. Now, imagine these larger funds when they bring on certain executives on board or certain key employees. You can't lose them. You got to deploy that capital. You got to keep recycling. So they need to deploy it. So multifamily was the next best thing. And, there was so much money that was, being invested in multifamily. So it started, making multifamily go hyperbolic. So I just wanted to kind of add that, because some of these firms, they have to buy. And in some cases they have to sell as well, because they make their profits off performance fees.
Yeah. Good point, August. Definitely. Now, I want you to talk to us, Reid, if you don't mind. In the past 15 years and the rise of syndicators, these barbarians that came into the market and started to compete with institutional investors, with their small retail investors investing fractional amounts to comprise the total equity needed for the deal. So maybe you can talk to us about that, please.
Yeah, it's very interesting. I mean, the first time I came across a syndicator was probably 10 years ago, and I'll never forget what he said. He said, if it's a good multifamily deal, I buy it. If it's a bad multifamily deal, I syndicate it. And so, I mean, and by good and bad just means expensive or a good, a good deal as far as, the value of the property. So it was an interesting concept in the fact that he would say, because I can just fee the heck out of these deals with an acquisition fee, a disposition fee, there's a mortgage fee. I've even seen the syndicators have like a fee if they give back the investors 50% of their initial investment, which is a pretty interesting thing, which I think most of the investors are happy to pay a fee if they get 50% of the money back immediately. So it's been interesting to see the rise of a number of syndicators. I've never seen more syndicators than I have in the last 2 years in the business. So it's exciting because there's just a ton of capital out there, throwing the money at multifamily deals. And it's interesting to see the different execution strategies and also see the similarities between a lot of the syndicators out there.
Yeah, and let's talk about that dynamic that exists between brokers and syndicators, because syndicators are, I heard not too long ago where a sponsor, another term for the general partner or syndicator, was had to explain to brokers what syndication is and what is this idea of all these investors. Talk to us about that dynamic, because yes, syndicators these days are competing with institutional investors. On the last two deals that we purchased, we competed with other institutions who were also had put offers on the property. But how is the view from a broker? Do you guys right away feel like, hey, that there might be a chance that the syndication might not be able to raise the equity needed? Do you do more due diligence as soon as you hear it's a syndication, or compared to Blackstone putting an offer on one of your deals? Talk to us about that, if you may.
Yeah, well, it's a great question, because what we typically do, especially on deals that we do a call for offers, if we get, anywhere from a dozen to 2 or 3 dozen offers in, we put everything into a grid matrix, show not only the price, but all of the other terms, the type of buyer they are, where their equity is coming from. And when we get it down to, maybe the top 3 to 6 buyers, what we will do is we'll ask them for references of their last 3 deals that they purchased. And by references, we're looking at the lender on the deal, the broker on the deal, and most importantly, the seller of the last deal. Because I've never come across a seller in 20 years in this business that if they had a bad experience with a buyer, they were quiet about it. So, that's something that we do on every deal. It's not just, syndicators, but they would fall in that same bucket, and it would be something that we would ask. We want to understand exactly where your funds are coming from. Where are you with the equity raise? I mean, a lot of people have discretionary funds available. Some people are, need to raise it. I mean, we actually had one deal that was a 231 unit deal here in Illinois that I saw. I knew they were syndicators. I saw them trying to raise money on LinkedIn for the deal that they had under contract of mine, because they're connected to me on LinkedIn, with about 2 days left in the due diligence.
Oh, no. So
don't be trying to raise money on LinkedIn 2 days before your due diligence is up. You better.
To their defense, at times that last amount, the syndicators could jump in and fund it themselves. So you might have like a couple million left there. You're trying to push it out, but you might have to step in and do it. Now, the last point that I wanted to make on this topic was, let me see, maybe I might have forgotten about what the point was, but I wanted to kind of, it'll come back to me. It'll come back to me, yeah.
For sure. Maybe I'll touch on a topic I wanted to and then
Absolutely.
if you remember it, then definitely jump back in. But Reid, you sitting as chair on many associations, and you have direct connections with many brokers and markets across the US, right? So maybe you could talk to us about the multifamily market nationwide. We know that, Texas, Arizona, Florida, and the Carolinas are doing really well, and other Sunbelt states, which have had tremendous amount of in-migration happening.
Absolutely.
But Question for you. Do you see these trends continuing and people moving from these densely populated and high cost of living states to these low cost of living Sunbelt states?
Well, it's definitely the flavor of the month right now. I mean, people are talking about the smile, the Sunbelt smile. I was just talking to somebody today. They're saying, they gave me probably the top 5 hottest markets. They're saying, if you find deals in this market, off market, let me know. I said, you just named the top 5 markets that you're never going to get a deal in, because they were new to the business. But yeah, I mean, I do see the migration out. I'm in Illinois. I'm in Chicago. And there's a significant migration out of Illinois into Florida, Texas. Same thing with California. My big migration, to Texas from California. So I see that continuing, especially in the no income tax states. As opposed to the ones like us where we are, taxed on all of our income on top of the Fed. I see that continuing, especially with the fact that what this COVID situation has done, we don't have to live in Chicago. You don't have to live in New York. You don't have to live in a major metropolitan area. In fact, I mean, we've seen it here in Chicago where people are pushing out further and further into the suburban markets because they can go get an apartment that is significantly larger for less money. They don't have to drive now an hour and a half to get back into their job. So I think with just the shift, and I it'll go back to a certain extent. People want to be back in their office, but I think this is a good percentage of it is going to be a change that is permanent moving forward. So I think that's just opening up new areas, and people that thought they never could move are moving now and going into, going up to the mountains or going to Florida or, wherever they thought they couldn't go. So
exactly.
I think it's a trend that'll continue.
First question is always asked, how's the Wi-Fi here? So that's what,
that is true.
That's awesome.
Great.
Now let's talk about my favorite topic. Let's talk about cap rates. It's the metric that apartments and multifamily is really assessed on.
Sure.
I mean, here in Vancouver and in Toronto, 2 of Canada's largest cities, we've seen cap rates compress every time. And every time that they do, experts cry like, this is not sustainable and we're in a bubble. But unfortunately for us investors, the trend has persisted for 15 years. With cap rates at 2%, we are seeing most multifamily assets in extreme negative cash flow. So when we see our partners in Arizona and they're complaining about cap rates compressing to around that 4%, and the rental yields are very thin, we're wondering if what happened to Vancouver and Toronto might end up happening in Phoenix and Austin. Maybe you could talk to us about this, Reid, and what is your view of the cap rates in these markets in the US that have seen this tremendous population growth?
Sure. Well, first off, I never liked cap rates because cap rates are such an arbitrary number. I mean, I've had so many owners say, my property is a 5 cap. I said, okay, well, let me look at your income and expenses, and they don't have a management fee in there, and they don't have, the rights, repairs and maintenance number in there. So if your NOI is not correct, cap rate doesn't mean anything. But to your point, the cap rates are compressing, and I have a number of groups that are trying to do IRRs, the internal rates of return, and they're saying, what is my 5-year exit cap? And I say, I have no idea what to tell you. I mean, usually you could kind of figure it out. You could maybe do 100 or 200 basis points different from what your going cap is. Now you have no idea because it's going to be a direct relationship to what the cost of capital is. And so if interest rates remain where they are, which they probably won't, then we can, the cap rates might remain the same. But if interest rates start ticking back up, those cap rates are going to fall right in line with those.
Exactly. Unless what's happening in Europe ends up happening, in North America, and we end up going to negative cap rates. Yeah,
you have to pay to put your money in the bank, right?
Yeah, and just for people that are watching, the value, how you determine the value of a multifamily asset is by taking that NOI that you were talking about, dividing it by the cap rate, and then that equals the value of the asset.
Exactly,
So
exactly.
just to kind of
But
touch
if
on
the
that,
NOI is not accurate, like Reid
it
mentioned,
won't make
then
a difference
then
what
it's
the cap rate is. Exactly.
Doesn't matter.
Exactly.
Yeah, we just call a cap rate one of the sanity checks in multifamily. I mean, you're looking at the cap rate, you're looking at the cash on cash return, you're looking at the price per door, you're looking at expense ratios. You know, cap rate is just one of the things you check off. It's not anything you buy on at this point.
Just to touch on that last point, that we're kind of
Yeah.
comparing Vancouver and Toronto with large markets in the U.S. like the Phoenixes and the Austins. Here in Vancouver and Toronto, you know, just like Ava mentioned earlier, you know, experts continually said this is a bubble, this cannot last, it doesn't make no sense. Nobody's going to buy a multifamily building if they're in, you know, there's negative yield, there's negative cash flow. Nobody's going to buy it, but people continuously buy it. But we also have a huge immigration that comes into Canada. 300,000 people immigrate to Canada every year, and majority of them want to live in Vancouver and Toronto. So that that creates you know, somewhat of a market right away. And also you got people across Canada that tend to move to Vancouver and Toronto as well. So we got our own version of inter-provincial migration, but the numbers just doesn't make sense. Look at us, real estate professionals that could have done our business here in our backyard, and we're buying in Charleston, South Carolina, buying in Orlando.
Yeah.
So because of those rental yields that exist, because of opportunities that exist, many other reasons as well. But what will, like, will there be a breaking point where investors will say no mas, and they will not invest no longer, they will not buy? Or because of fears of inflation, because of other concerns, they will continue to buying? Obviously, it might not make sense for syndicators no longer, because they can't send those monthly distributions, which are very, you know, that investors love, because there's no rental yield to do so. So what's you know, what's going to happen in the market? And now, if you lose that kind of huge amount of syndicators who bring, you know, hundreds of thousands of investors with them, that might affect the market as well. So I'm just kind of envisioning what could happen if if the cap rates go lower and the rental yields go lower across the U.S., like they've done in California and New York, they've done in Los Angeles and New York. I mean, that has happened there.
Yeah, well, I mean, New York's decimated. It's probably the worst multifamily market right now, just from what they're doing out in New York with the, you know, the rental caps and all of that. But, you know, the thing that I've noticed is the metrics for renters entering the market now is the best it's ever been, and it's only going to get better. We are a renter nation. Nobody, you know, the dream of owning a home is no longer top of mind to the millennials and the younger generation. I mean, many of them saw
the subscription-based generation. They are.
I mean, they want to be able to pack up and leave and move to Toronto, or move from Toronto to California, whatever. They don't want to have to put their condo on the market, try to get that, you know, that sale before they buy another condo in another market. So, you know, the fact that they can be nimble and move wherever they want and, you know, adjust accordingly. I just think we're a renter nation, which is, and also the affordability gap is widening. So, you know, nobody is able to, I shouldn't say nobody, but most people now are not able to even scrounge up the 5% down to buy a house. So it's keeping them in, you know, apartments, workforce housing across the country, and you know, probably in Canada as well. So I just think the metrics are going to continue to improve on the renter side. But yeah, I agree with you. I mean, there's going to be a point where somebody says, look, I'm out, I'm tapping out of multifamily. You know, if the cap rates are now, you know, 3 caps in a secondary and tertiary market.
Yep. For sure. Those larger investors for sure, but investors who are making their living off performance fees and management fees is just not going to be sustainable, because they're not going to have investors coming on board. And just touching on Vancouver and Toronto, I mean, talking about difficulty purchasing your primary resident, with median home price at around 1.3 million, between $1 million and 1.3 in Vancouver and Toronto combined, and a median income at 90,000. And I just saw a report where most first-time home buyers are getting a huge amount of help from their parents. Their parents are putting up the majority of the down payment. Well, what if the parents were not in a financial situation to do so? So I definitely believe in this idea. But also, one more thing is, you guys, Americans, you guys are really good at building these fabulous structures. I mean, we went to the property that we bought in Charleston. It was beautiful. I mean, this
Beautiful.
resort style, garden style apartment building. I wouldn't mind living there at all. I mean,
Everything's right outside your door. You got the pool,
Yeah.
the fitness center, the clubhouse, everything's right there. It's just
Beautifully
fabulous.
built.
Yeah. It seems like now with the new developments, it's like a race to amenitize. I mean, you're doing the dog washing stations, and one of the guys at one of the multifamily conferences I went to downtown Chicago was saying, this guy's given, the dogs massages in his building. So, I put a dog washing station in, and now he's massaging the dogs in his. So it's just,
Yeah.
it is a race. And,
That's awesome.
most of the time nobody uses it. Pool in apartment complex is a draw to sign the lease. The person might never, even dive into the pool.
Right.
But yeah, it's
That's why nobody was
crazy.
there. That's why nobody was
There's
there.
a couple people sitting outside of the pool.
Yeah, no, for sure. Great
That's-
conversation
yeah,
here.
that's really funny.
Okay, great. We can
Why
move
don't
on to.
let's discuss longevity. Our group at CPI Capital, we started in the multifamily space just a couple years ago and plan to be in the space, for the entirety of our professional careers, which is going to be 30 to 40 years more, hopefully.
Yes.
But another important point is that groups like us who partner with investors to acquire our properties need to be extra diligent, as we have a reputation to protect, obviously. Because no one, of course, wants to invest with a fund manager who loses their money. But Reid, what is a blueprint to success in the multifamily investing space long term?
I think it's just persistence.
Right.
I mean, you just have to, not only do you have to have a database that you can rely upon, and for you as investors, I would have a database of, the brokers and the lenders and everybody in the markets that you're trying to, to purchase deals. In our business, our database is our lifeblood. If you don't have a good database, you don't have anything. And then, just staying in contact with the right people consistently, which is where the persistence comes in, is the key to success in the multifamily space.
Great.
Consistently, that's the key
advice.
right there. Thanks,
Great
Reid.
advice. Okay, awesome. So we get to the next segment of our show. We're gonna have some fun with Reid. Really appreciate all your wisdom and knowledge that you shared. I hope to get you on at some point in near future and kind of go over our predictions and kind of what we
Totally, yeah.
discussed and where the market is at. So awesome.
Yeah, that
So
would be
let's-
really Reid, we're going to start the 10 championship rounds to financial freedom. Whatever comes top of mind, we're going to ask you just a few questions here.
Okay.
Let's get started.
All right.
Who was the most influential person in your life?
Oh, wow. I would say it was the director of sales in my office, John McDermott. Taught me a lot of stuff about the business, taught me a lot of, just has been a friend throughout the entire process.
Amazing.
Very nice.
Amazing.
What is the number one book you recommend?
I just finished one called Atomic Habits, and it's interesting because it's a lot of things that you probably have heard of or know, but it was all in one single book. You gave me one. The other one is 5 a.m. Club. I don't know if you guys have ever heard that one, but talks about the specific things to do starting at 5 a.m. for the first hour of your day and how it sets up everything for the rest of your day. Those two books. I mean, I've been reading a lot of things about habits and, you're just trying to quell the procrastination that I inherently have in my body.
Yeah, all of us do, and that being more productive, I mean, is a mastery that takes a lot of diligence to polish.
I wrote these books down, so I'm going to be purchasing.
Yeah.
Thank you for sharing that.
Yeah.
Next question. If you had the opportunity to travel back in time, what advice would you give your younger self?
Oh man.
Don't be a residential broker.
Hey, right. No, I would have started investing much earlier just because of compound interest and, the valuations that have gone up rather than keeping money in a stock market or trying to put money into a Roth IRA every year. I would have done it. I would have started investing with my clients faster, and I would have bought more, even smaller buildings myself earlier.
Nice. All right. What is the best investment you've ever made?
The best investment I ever made. It was a 144 unit apartment complex that I was selling to one of my clients, and his main whale investor died at their Christmas party. And so he said, look, I have to back out of this deal. And I said, I totally believe in this one. It was I'll never forget it. It was 18 buildings. The previous owner tried to condo convert the 18th building. It was a soft market, so he just re-rented them for $150 higher. So I said, look, all we have to do, and he only put like $4,000 a unit in to get that $150. So I said, all you have to do is put this money in for the rest of the units. You just increased this property by about $2 million. We ended up helping him raise the money and investing in it ourselves. We doubled our money in the first 2 years on that deal. And it was, I've heard of better home runs, but that one was fantastic for me.
That's the magic of multifamily value add, which Ava loves to talk about. Which
I like to call wealth building machines, and that just proves
Absolutely.
it right there. Right?
And to a lot of not really super sophisticated investors, when you talk about how $150 rent increase across 100 units could increase the asset value, I mean, depending on the cap rate and a few hundred metrics, by millions. They just their eyes start glowing because it's what maybe it does fall in love with the space as well.
100.
I mean, it's ridiculous. I mean, just to give you an example, I sold another 142 unit deal to a guy that believed what I was telling him, which was it was owned for 43 years by the same owner. They were month to month, and they were all $200 below. And he went in the first month and said, "Look, you can stay month to month." But I'm going to raise your rent $200. If you sign this lease, I'll only raise your rent $100. He got 118 people to sign that lease, got everybody the next month, and then raised the rents the following year 10%. So he just cashed out of that one. It was $10 million higher.
Wow.
And he got a cash out refi.
In Canada, he probably would have been thrown in prison. Strict rent control here.
Only 1.5% per year you're allowed to raise rent. So
That's
just
crazy.
for people listening, again, this is another reason why we're in love with the US is because it's so business friendly and there's no rent control.
Yeah. In most certain areas, not New York and not California.
Yeah, sorry, in most cases, in the regions we like.
Right.
So now I'm curious, what is the worst investment you've ever made?
Probably not investing in a deal.
Oh, wow. Yeah. All right.
I mean, most of the stuff I've been too cautious about, so I haven't lost anything in the investments. But there have been some that I did not invest in that I really wish I would have. So that would have been the worst, is not investing.
Not pulling the trigger when you know it's a good opportunity.
Yeah.
Now, Reid, how much would you need in the bank to retire today? What's your number?
It's funny, that number changes every year, but I would say, well, I would never keep my money in the bank, right? So, I always said, you give me 20 million cash, I'm done doing any kind of work, but I'm going to be investing.
Absolutely.
Nice.
So that I don't know. That sounds like a nice round number.
For sure.
Yeah.
The common answer we get is 10 million. So yours is double. So good man.
It used to be 10 million, but 10 million doesn't get you anything anymore.
Inflation over 5%.
Right.
All right. Next question. If you could have dinner with someone dead or alive, who would it be?
Oh man, I should have thought of all these crazy questions before you had me on. I would say it would be my great grandfather that I never met, that I'm named after. It's not anything very interesting. It would just be because he's in my bloodline. So,
did he immigrate to the U.S. or was he somewhere else?
He was second generation. So I'm a complete American mutt by now, but he was second generation coming over.
Wow. Okay, cool.
Awesome. Now, if you weren't doing what you're doing today, what would you be doing now?
If I wasn't doing this, I'd probably be doing what you guys are doing. I'd be syndicating deals.
Yeah.
All right. Come on over, man. Come on.
Absolutely. You guys have all the fun.
Join the forces with the barbarians over here.
This is my favorite question, Reid. Book smarts or street smarts?
Street smarts all day.
Woohoo! Nice.
Street smarts all day.
Okay, this is the last question. Okay. If you had $1 million cash and you had to make one investment today, what would it be?
Multifamily asset.
Amazing.
Yay. Yeah.
Hands down.
Amazing.
Hands down. Look, as I say all the time, with retail, everybody's shopping online, so you can shop virtually. So retail's struggling. Everybody now can office virtually. Until they figure out how you can go home into a phone booth and live virtually in a 20,000 square foot mansion, it's going to be multifamily.
Absolutely. I always say that. That's what we're believers, and we've dedicated our lives to this business.
Yeah.
Reid, what's the best way people can reach you?
You can reach me either by email, which is reid.bennett@svn.com. That's REID.BENNETT @SVN, or my cell number, 773-251-7342.
Fantastic. You are just awesome and a wealth of knowledge. So thank you so much for being on our show today.
Thank you for being on our
Absolutely.
show. We'll catch you on LinkedIn, my friend.
That's right. That's right. All right, guys. Thank you.
Thank you.